What if I showed you the exact click-by-click process of how to invest in Apple? Not theory, not motivation, but the actual step-by-step execution, so you can open your phone or laptop and do it yourself today. Most people say they want to invest, but they never move from thinking to executing. In this video, I will show you the complete process of investing in Apple stock properly, the right order types to use, how to avoid common beginner mistakes, and what realistically happens after you press that buy button. Hello, I am Nate, and I've been working at Pullman's Bank for the last 10 years. During my banking career, I've seen one simple truth. People who understand the process take action confidently, while people who don't understand the mechanics stay stuck. So today, I'll walk you through exactly how to invest in Apple Incorporated step by step. The first step is opening a brokerage account. You cannot buy Apple shares directly from the company. You must use a regulated brokerage platform that gives you access to the stock market. Apple trades on NASDAQ under the ticker symbol Apple. Reputable low-cost brokers include Fidelity, Charles Schwab, Vanguard, Robinhood, E-Trade, eToro, and Webull. When you sign up, you provide your legal name, address, date of birth, tax identification number, and upload an ID for verification. This usually takes about 10 to 20 minutes. If you're outside the United States, your broker will likely require you to complete 8W, 8BIN form to reduce dividend withholding tax. Once your brokerage account is approved, the second step is funding it. Inside the platform, you will see an option such as transfer funds or deposit. You connect your bank account and initiate a transfer through ACH, bank wire, or sometimes debit card. ACH transfers usually take 1 to 3 business days. After the funds appear in your brokerage account as available cash, you are ready to invest. Now comes the practical part. Log into your brokerage platform. At the top, you will see a search bar. Type Apple or the ticker symbol Apple. Click on Apple Incorporated and you will see its stock page. This page shows the current price, daily change, charts, company profile, financial data, and news. Next, you click the buy button. This opens the order screen. Here you must choose your order type. A market order means you are buying immediately at the best available price in the market. If Apple is trading at $190, your order executes instantly around that level. A limit order means you set the maximum price you are willing to pay. For example, if Apple is trading at $190 but you only want to buy at $185, you enter $185 as your limit. The order will only execute if the price drops to that level. Beginners often use market orders for simplicity, while limit orders help control entry price during volatility. After selecting your order type, you must choose how much to invest. You can either enter the number of shares or the dollar amount. If Apple is $190 per share and you enter 1 share, you will invest approximately $190. If you only have $100, many brokers allow fractional shares, meaning you can enter $100 and own approximately 0.52 shares. This makes investing accessible even with small amounts. Before confirming, review the order summary. It will show the estimated cost, any fees. Many brokers now charge $0 commission for U.S. stocks, and total amount. Once you're satisfied, click Place Order or Confirm. That's it. You now officially own shares of Apple. They will appear in your portfolio section. Now let's talk about what happens after you invest. Apple pays a quarterly dividend, recently around 26 cents per share per quarter. If you own shares on the record date, you receive dividend payments in cash to your brokerage account. Most platforms allow you to enable DRIP, Dividend Reinvestment Plan, which automatically reinvests those dividends into more Apple shares, accelerating compounding. Let's look at an example. Suppose you invest $1,000 when Apple is trading at $200 per share. You would own 5 shares. If the stock rises 10% over the next year to $220, your investment becomes $1,100. If dividends add roughly $1 per share annually, you would also receive about $5 in dividends, making your total value around $1,105 before reinvestment effects. Now imagine holding for 10 years with an average 8 to 10% annual return. That $1,000 could grow to roughly $2,100 to $2,600. If you invest $1,000 every year instead of once, long-term growth becomes significantly larger due to compounding. However, investing also involves risk. Apple is considered a blue-chip company, but its stock price can fluctuate significantly. Risks include high valuation levels, competition in smartphones and services, regulatory pressures, supply chain concentration in China, and global economic slowdowns. Even strong companies can decline 20% to 30% during market corrections. If you panic sell during downturns, you lock in losses. If you prefer diversification instead of buying Apple directly, you can invest through ETFs that hold Apple as a major position. For example, the Vanguard S&P 500 ETF, VOO, managed by Vanguard, or the iShares Core S&P 500 ETF, IV, managed by iShares, both include Apple among their top holdings. By buying these ETFs, you indirectly invest in Apple along with hundreds of other large companies, reducing single stock risk. Before investing, always review Apple's quarterly earnings, revenue growth, profit margins, free cash flow, and analyst expectations directly inside your broker's research section. Intelligent investing is based on understanding the business, not just buying a popular brand. To summarize the exact process, open a brokerage account, complete identity verification, fund your account, search for Apple, click buy, choose market or limit order, enter shares or dollar amount, confirm the order, and hold for the long term while monitoring performance and reinvesting dividends. That is the complete execution process of investing in Apple stock. Investing involves risk, including potential loss of capital. Past performance does not guarantee future results. Always make decisions based on your financial goals and risk tolerance.